notes. Okay.
How are you doing, Wes, anyway?
Josh, you going to join? You want to join? What's he saying?
What's that, sorry?
No, did you ask me something?
No, I was just going to say, I'm on YouTube, live on YouTube. Wes isn't on YouTube today because you've got painters around at your house, haven't you?
Yeah, I've got painters, yeah.
So yeah, the YouTube live might be a bit strange. It might be just me talking, but we'll go with it.
Yeah, that's right. Yeah, so today we're going to talk about Adobe. Has the growth of a bubble popped? And then we're going to talk about that thing that replied to my story, the Mr. Market analogy.
Yeah, the three main elements of Mr. Market.
Yeah.
Really, really important. And it's really interesting to talk about. So, yeah.
All right.
Another mate.
I've got a coding assignment to do. I'm like halfway through it, so I just want to ask Lewis a quick question.
Yeah, let's go for it.
We got a rental property recently.
Yeah, I completed it last week.
So yeah, well done for that.
Cheers, mate. Thank you.
So I've been like debating myself for ages. So I was like looking at like the maths and everything, and I can't quite understand the appeal between a rental property versus like a ETF REIT.
Yeah.
How come you got a property and not a REIT? Just out of interest.
That is a really good question, and there's a reason why I don't own REITs, and the main reason is because when you own a property, on its own, you control the cash flow. So think about a business. If you own the full business, whatever you want to do with the cash flow, whether you want to pay a dividend, whether you want to buy, invest in the business. So with a REIT, that would be buy more properties. REITs are set up in a certain way that they have to distribute the profits. So yeah, because of the way it's set up, real estate investment trusts, they have to distribute so much of their like yearly profits, and in my opinion, that stops a compounding machine. So if I own my rental property, hopefully I get a few more over time, the profits can build up, and then hopefully can add more and more to the portfolio. Whereas with REITs, you don't have full control over that, and that's my main reason, really.
And see, that's a really good point. The other thing I was going to ask, like with like a REIT ETF, like you're diversified, so
yeah,
really, really well. So you've got like parking, offices, hospitals, I think some roads actually.
Yeah, there's all sorts of stuff. Yeah.
Yeah, and like it's diversified to part, but like for instance, if you own a house in like I don't know, let's say like Newcastle, for instance.
Yeah.
Like I was in Newcastle. Oh, sick. But yeah, let's say like so in Newcastle, let's say I don't know, like the train station gets blown up or something, and obviously the house prices all go down in value. That's like quite a lot, like a big risk. Obviously, that's a massive, like a ridiculous statement. But for instance, if something happens in Newcastle, and all the house prices go down, that's a lot of exposure and a big downside risk. Yeah,
100%. You're right. A good example might be flooding or fire. Yeah, flooding's probably the best example of that because, if we all believe global warming, you'd assume certain parts of country, with this big storm we just had, some places are flooded and some places are prone to flooding. I just wouldn't want to invest somewhere where there's been historical flooding. Yeah, it's a hard one because if you've got a big capital outlay on one property, yeah, you do have that risk. That is totally fair enough. You just got to look at the chance of that kind of thing happening. That's the way I would look at it. Something to maybe counteract that would be if you're going to buy a few houses, don't buy them all in the same street or all in a row. So like, what if it's a gas explosion and you had 3 properties in a row? There's like extra risk there. So maybe, don't have them all on the same street, have them popped around, maybe different towns, different cities. That's maybe a way of getting over that risk. But yeah, it is a risk for sure.
Interesting. And the last thing I would say, so I think, because I was researching this last night actually, REITs have like outperformed. They've actually outperformed like the S&P in the past like 15 years,
Yeah.
which is quite mental. And obviously, like they've outperformed housing in terms of like returns. Like, how like does that not convince you otherwise as well? Obviously, like we don't know what the future's going to be, but
yeah, I'd say that everything since the financial crisis has gone up, especially real estate or real estate property. Everything has pretty much gone up. I'd like to see how much leverage these REITs are using as well, because a lot of the time, well, I think it's 70-80% of property transactions in the UK are used via a mortgage, whether that's buying your own home or, you know, a big company buying property. It's done via lending. So yeah, if you're using a lot of leverage, you're then heavily exposed. It would be interesting to see how much leverage these REITs are using to buy property, because leverage does amplify your returns. And if real estate since 2008, 2009 has it's basically just gone up, and you use debt as well, your returns are going to be outsized. So,
okay, no, thank you.
yeah.
That clears up a lot.
No worries. It's an interesting debate, yeah. We could probably do a full show on it, to be fair, because I've sat down and thought about why don't I just buy a REIT, but I do have my reasoning behind it.
Like, that's the thing. And like for me, like real estate's like never appealed to me, but like in like certain events, like, you know, the housing, like I love crisis. Like when you have like the 2008 financial crisis, like property prices just went right down. I was looking at all the REITs and it was just like, you know, what a time to be alive. House builders
in the UK. So from the start, the top 10 house builders in the UK make up 50% of all the new builds. So what's a monopoly between a few different, is it oligopoly or something? So that's kind of an oligopoly. So the top 10, you're talking Barratt Homes, Persimmon. And if you have a look at the stock chart, March 2020, crash, COVID. 2008, absolute crash. And we've got a few famous UK value investors. I can't remember what he's called, but he buys UK house builders. He basically loads up on them when there's a crisis, because the PE ratios go really low down, and it's just a bit of a no-brainer because houses are always going to get built because we've got a bit of a supply and demand issue. So that's a way of getting exposure to real estate, property in the UK. When we have a crisis, buy house builders.
I presume you're just gonna like rant all about Kathy Woods, right?
Pretty much.
No. No Kathy Woods today.
Okay. See you in a bit, lads.
I'll see you.
Cheers, Crenshaw. Appreciate it, mate.
Alright then, so yeah. Okay, so we can talk about as the growth bubble popped, we can talk about Adobe and missed the market 3 points, right?
Yeah, let's go for it, mate. Let's go for it.
Right, then let's start. This is what I wrote. As the growth bubble popped, within the last 2 years, we have seen an influx of new investors flood the market. Many have done the smart thing and invested in an index fund. Some learn how to pick individual stocks by correctly valuing securities in a conservative way. Then you have investors who came to the market and fall into the trap of investing in so-called growth companies that have no path to profitability, or trading at an extreme valuation that make the .com stocks look cheap. Those who fell for the hype believe these stocks will grow to the sky forever, and that the fundamentals and the price you pay didn't matter and nothing could ever go wrong. Fast forward to February 2022, many of the companies that were pandemic favorites for new participants, like Teladoc, Palantir, Square, DraftKings, and many more, have all fallen more than 50% respectively within a short period of time. It is important to highlight that insiders that are invested in these companies aren't going to be the ones that will lose. It will be the average retail investor that bought at the top that will be left holding the bag on, wondering what went wrong.
Yeah, well, what can I say? Yeah, that is a great statement. And it is very true. I think since the pandemic, more people than ever seem to be interested in investing, be it the stock market, be it crypto, be it any investments. It seems like it's just become quite a popular thing. People have had more disposable income, weirdly. unless you've been like adversely affected by the pandemic.
Mm.
A lot of people have more cash in their pocket because they haven't been able to go on holiday. They couldn't even like, so let's say if I wanted to spend a few grand doing the kitchen up, they can't because no one could come around. So we've got that pot of money. People working at home, not traveling, you know what I mean? So people have got more money and people go into investments, and that pushes for speculation even more.
Yeah, I agree. So here are some of the stocks that are down. It's the one I sent you that usually is. So you got Clover 93% down, Wish 91% down. You have Bumble 67% down. You have DraftKings 75% down. You have Lemonade 82% down, and you have Roku 78% down. So those are huge drops you're talking, aren't you?
Yeah,
Like, yeah.
that is unbelievable. That I did not know that. When you sent that across, I knew the odd company has fallen by that much, but yeah, that is massive drops. And when something drops like that, the gain you'd need to break even again, it's almost impossible.
Yeah.
You know what I'm saying? So, like, what was on the Roku, for example? They do something to with television. It's like Netflix, isn't it?
It's like the Fire Stick, I think.
Oh, right, okay. It's like Fire Stick, yeah. 82% drop. I don't know the maths to get back to break even, but you're talking thousands of percent to. Yeah, so that's absolutely crazy. In the past year, so there's a lot of stocks which have done that.
Yeah, that's true, and a lot of people are stuck in these investments. So, like, what is the best option for them, really? Like, say, like you're stuck in these investments. What would be the best option for you?
That's a really good question because I'm not in that position, thankfully. I've got stocks in the red, but I've trained my mindset that I don't actually care. The companies I invest in are in the red. But if you're in that position, I think you've got to learn lessons from it. The worst thing that you could possibly do is run away from investing, because I'm of the belief that you have to invest in whatever way. You have to invest over the long term to secure your financial future. Now, that might sound a bit corny, but it's true. No one's coming to save you. In my view, state pension's very low anyway. And when we get to that age, it'll end up being 75, 80 before you get it. So no one's coming to save you. So anyway, a bit off topic. But yeah, learn a process. Use this as a very expensive lesson. You know, if you're down 82% on the stock, and you've just been buying them willy-nilly, no process, treat it as an expensive lesson. Treat it like you've just paid however much for an expensive lesson, and now start learning a proper process and go from there.
Yeah, I mean, I completely agree with you, and we spoke about this before. Like, you know, in 2000, you got like those Intel, where they go like 22 years where they haven't touched their height again. But with these companies, I don't think we'll ever see them reach their all-time highs again, regardless of how much they grow and turn into brilliant businesses.
Yeah, 100%. Intel and Cisco are the two big names of the tech bubble, of which their businesses have actually been quite successful. You're talking thousands of companies in the tech bubble which just went away. Pets.com, basically anything with .com went to the moon in 2000 terms. I don't know if it's necessarily a tech bubble 2.0, but stocks were or are in a bubble. But you know, you say like Roku's down 82%. I haven't looked at Roku stock. I can't really comment too much on the business, but it could drop further. I don't know if it's loss making. Then companies that are loss making have no cash flow, have no profits. The way you value a business is the net present value of future cash flows. So if all of these companies have got massive losses, you're talking your Teledocs, your Rokus, them kind of companies, it could drop further because there's no fundamentals behind the company.
Yeah.
And the price is just being driven by
fundamentals that will say this can go back up in the future. Like, it's not like they can say we've got zero debt, we make this amount in cash flow or that kind of thing. Like,
yeah, that's it.
Speculation kind of companies, like they have nothing. Let's see, but it's interesting to see, and like I was invested in a few of these names actually. That when I first started. Yeah, I could tell you which one I was invested in.
So you made, what you're saying, Wes, is you're basically an expert trader now.
I'm a momentum trader.
You got out at top and then you learned value investing. Love it.
Yeah. So I was invested in CRISPR. I bought it around 180.
Oh wow, okay. Yeah.
Yeah, and I think I had around 7 shares at the time.
All right, okay.
At 180. Then the stock literally went down to like 120, and I lost a lot of money on that one. But luckily, because my portfolio was like I was making money, obviously, like it made that look like nothing really.
Yeah.
So I kind of got lucky. Not many people are lucky in that kind of sense, but it's still a lesson to be learned, really. And what else was I invested in? I was actually thinking of buying Wish as well.
Oh wow.
Yeah.
Was that I was going to say, was that an IPO at the time?
Yeah, it was an IPO. Yeah, Wish, and Wish is down 91% now.
Oh, 91. But wow. 91%.
Space, which is Virgin Galactic, right?
Yeah.
I was invested in that. It's down 85% now, but when I bought it, it was around $6, and I sold it when it had that short squeeze.
Oh yeah.
And I got out of it then. But yeah, there's a few of these names, like around 2 or 3 that I was invested in, but January last year, I just got rid of every single thing, start fresh. Like,
well, you did the right thing.
Yeah?
You did the right thing, mate.
Yeah, I could have easily said, I'm making money, like, I could easily continued it, but now I was like, nah, let's just sell everything, start fresh, like, learn how to invest properly, and just go from there, really. But yeah, there were some lessons there. And
100%.
Hope people can learn lessons as well. But
yeah, I mean, so we're talking in a 12-month period, a lot of these stocks have just absolutely collapsed.
Yeah.
The tech bubble in 2000, it was quite similar in a way. It didn't happen just overnight. Everything just went down. It happened over a few years period. Like valuations reverted to the mean. The speculation period was over, and companies with no fundamentals went back down to where the fair price was. A lot of them went to zero because the companies were rubbish. But yeah, I'm going to say valuations always revert to the mean. A stock price over the long term will go up if the earnings and cash flow goes up.
Yeah.
Unless they issue loads of shares, but you'd hope they wouldn't do that. But it's simple. Valuations revert to the mean in the long run. It's just what happens, and yeah, it's no surprise to me that these companies are going back down to where they belong.
Yeah. A lot of people are saying these are great companies on discounts. Like,
yeah, good luck with that. You need a lot of luck.
I mean, there are actually 1 or 2 good businesses here. Like, there's PayPal, I'm seeing. 10% Music, they actually make a lot of money. And I think that's about it, really. Everything else is just non-profit SPACs and ad companies. But, yeah.
Yeah, it is interesting. It's interesting to see how it'll all play out. Yeah, let the businesses mature and start making money. That's the way I see it. Don't have anything against these companies. Don't have anything against them at all. But if you're going to invest in something, you want to invest in something which makes money. It might seem like common sense, but that's one of my key principles: invest in stuff which makes money. Yeah. If you want to buy something cool, I don't know, buy a nice T-shirt or something, or a hat. Don't put your money into something which Lesson learned. Yeah, Robin Hood. And they went down loads, didn't they?
Yeah, they're down 86%.
Wow.
Yeah, that's crazy.
It shows how much. $11.81. Wow. No PE ratio though, just loss making. Yeah. So this is what happens. Markets get frothy. It happens all the time. 2000s it happened. It happened in the late 60s, early 70s in the Nifty 50. Back when McDonald's and Coca-Cola were growth stocks. It happened in the 50s where carpet companies were like the new revolution. They were like tech companies. Obviously 1929, pure carnage. Bubbles happen all the time in lots of asset classes, not just stocks. So, yeah.
Something to... It always starts with a grain of truth as well, then you get extrapolated.
Yeah, 100%. It happened in the 1600s with tulips. The tulip bubble. Tulips cost like more than houses or something equivalent, which is crazy. The South China Sea bubble. Isaac Newton got caught up in that, but it's interesting to learn about bubbles because it helps you as not just a value investor, but it makes you understand that there's euphoric times and there's really bad times, and the way to make the most money in investing in any asset class is buying when blood is on the streets. You know, when valuations are really low, buy good assets at cheap prices, and you'll do well.
Today I saw that the Russian market crashed 12%.
Oh, really?
So it could be interesting for the European and US market. So
yeah, it'd be interesting to see if Russia invade. Who knows what will happen with the market, but you'd assume Russian stocks would fall quite a bit. Gazprom's a company which I find quite interesting because they've got such they produce like they send 40% of Europe's gas, but I don't think I would because of the political risk on it. I don't. Yeah, and the Russian state own most of quite a lot of the company, so at any time they could just take it away. So I'll stick with Equinor, the Norwegian oil company. I trust Norway more than Russia, which I think is a fair statement.
Should we go on to Adobe now?
Yeah, let's do it, mate. Let's go on to Adobe.
Adobe, right? You're the one that has done, the research on it. So tell me about Adobe. Tell me what they do, and tell me some fundamentals that you like about them. What, like their margins, their return on invested capitals, that kind of stuff.
Yeah, let's do it. So let's start with the business first. So Adobe systems. So most people will know Adobe because they invented the PDF. So anyone that uses a computer, PC, will probably know what a PDF is. I don't know how to describe it. It's a PDF. It's like a certain way of looking at a document on a portable document format. That's what it is. But yeah, the company itself produces software. It's got millions of users worldwide. It's got a few flagship products, including Photoshop. So that is like a image editing software, Adobe Illustrator, Acrobat Reader, which is where the PDF comes into play. But yeah, so they're a really interesting business because they're now a subscription software business. but yeah, they've been around since like the 80s, and they're on it a long time, yeah. And alongside Microsoft, to say they're on every single computer PC on Earth. So yeah, in terms of like the fundamentals behind it and what I really like about them is the company is just extremely high quality in terms of its margins, the amount of debt it's got, its return on equity. It is one of the highest quality companies out there, in my opinion, based on all of them things. And it's interesting because I'm trying to think of other companies. Microsoft are quite comparable business model wise, but they're not at the same time. Adobe are a lot smaller, but anyway, I'll get to some of the fundamentals and why I do like them. So we've got a gross profit margin of 86%, which that is high. That is very high. Software companies do have higher margins, but it's just consistency, which is fantastic. The net margins, 28%. That's a 5-year average as well, by the way. So that is pretty decent, really. And return on equity, 5-year average is 36%, which is extremely high, very, very high. They don't have much debt either, 24% long-term debt to equity. So you're talking not a lot of debt compared to how much profit it's got in the business. So there's not much gearing at all. They have grown their business using their profits, and that's something I really like to see as well. You know, they've got a strong balance sheet, they produce a lot of cash, they're growing nice and consistently. Last year they had a really good year in terms of growth. That's maybe why the stock price went quite berserk, because did they double the revenue? I should know it. No, we didn't quite double it, but over the past, since 2016 to 2020, I need to get 2021's numbers up. I didn't have them for this video. Yeah, in the past 5 years, they've like doubled the revenue. So it's a company which is growing. It's consistently growing. Interesting to see how long the growth will be there, but they've got a subscription-based revenue model, which is really, really good. Which means
for them, right?
Done really, really well. Yeah. So instead of paying one-off for the year, you pay monthly. They can end up charging more for that, and they get the cash through the door quicker. So it allows them to do more stuff in terms of, if you get your cash in monthly, it means you can do things a lot quicker.
Yeah, it's true.
So the only thing with Adobe is the valuation. Literally everything about it is fantastic. The only thing is the valuation, which it's not entirely surprising, is it, in the current market climate? As value investors, we want to buy good assets for a fair price.
Yeah.
I know it's fallen a little bit recently because I do have it on my watch list, but it's a hell of a long way from my fair value, which I think
What is your fair value?
I think my fair value is $225 per share for a 10% return. And that's using quite reasonable free cash flow. Yeah, nothing too fancy. $225 per share at 10%. What was yours when you had a look?
I actually haven't done mine yet. Let me see if wait.
Yeah, I'm just having a look at all-time highs to where it's at now. And if you look at all-time highs, it's down 34% from
34?
Yes. It got to like $680 and it's now at $446. But it's still a long way off. It basically needs to half again. So it just shows, even if the stock falls 34%, it doesn't mean I'm interested.
Yeah. You're just going to be patient, really, with it.
Yeah, this is one to be patient on. This is one of the many stocks on my watch list which I really do want to own at a fair price. But the way you make money in the stock market is buying at a fair / really, really discounted price. Adobe is such a high quality company, not much debt, really high profits. It's got a strong moat, I personally think. And yeah, when it gets that price, whenever that is, I'll be a buyer. Simple as that, really. and it is truly one of the best I've seen out there. Just for quality wise of the business, just the amount of profit with as little debt. Yeah,
margin as well.
I just really like it. I really do like it.
Yeah, it's definitely a company I wouldn't mind finding a spot for in my portfolio.
Yeah,
I do like it. It's an interesting one.
Yeah, just trying to. What did it go to?
What was your growth rate and stuff like that with when you was doing it?
So for my DCF, I think I've spoken about this before. This spreadsheet I've got is actually from Learn to Invest channel, a guy called Jimmy. So Jimmy, I use the free cash flow estimates. I use the free cash flow estimates from marketscreener.com. They've pulled together like different analyst estimates, so I put them into it. But I also do use the Everything Money one, where it's a bit better to show the growth rates, and they both came out at a fairly similar figure. Might have been a bit lower on the Everything Money one, but the company itself, you'd expect its free cash flow to go up as well, even if the revenue might. What I'm saying is the revenue might grow at 10%, but the free cash flow could grow quicker because it's high margin business. But my free cash flow numbers are like out of this world. It's not like I'm putting mega growth into them. Just reasonable for the size of the business. Trying to do it off the top of my head. Might even be 10% growth from my free cash flow, which isn't anything. It might be a bit higher, but you know what I'm saying. It's not like I'm putting 40% growth year on year. 40%
growth, a bit unrealistic.
But yeah, no, high quality business, which will own at a fair price whenever it happens. And yeah, it's as simple as that. It's just on my watch list, ready to go.
Yeah. I've added it to my watch list. I just need to, value it and stuff like that. And obviously,
yeah, if you've got a 15% return, I reckon you're going to be looking at 150 to 180 or something like that. But yeah, it just depends on what required rate of return. Like a little bit off topic on Adobe, but I said to you today that Google's really interested in me. I'd like it to drop a little bit more, but buying a great business at a fair price is what I'm all about. And I believe the growth rate for Google is still there. Trailing 12-month PE, it's at 23. I think if I could buy it below 20, then I think that'll be very, very interesting for how high quality Google is as well. No debt, high margins. Yeah, it's piquing me interest anyway. I'll put some earnings. What am I about? Stock price notifications on my Yahoo. So if it hits the price, I'll just go ahead and start buying some.
Okay. Yeah, Google's another one that I like a lot. It's a good company. That
very good company. The business model is absolutely solid. There's no real competitors for the search business.
Exactly.
And that's why I'd be happy to buy it at a little bit of a higher price. Like there's some stocks I own where I think I'm going to get 12-15% returns. Rio Tinto, British American Tobacco. But Google, if I get 10% return, I personally think owning Google's better than owning the market. So I'm more than happy to do that. Yeah.
Agree. When is their stock split happening as well?
I have no idea. Probably in the next few months. Maybe soon.
Because you're gonna have access to the stock split, aren't you? If you own that one share, you get 20. I think it is.
All right. Okay.
Yeah. But
hopefully, will that make me richer? Will that make me richer with earning more shares?
But yeah, hopefully, Google can crash crash like Facebook or something. Oh, some 15.7. Okay, not long ago.
Oh, July.
That is long, actually.
But the stock split doesn't mean anything. Like, it's just a marketing ploy, and they're doing it so they can get in the Dow Jones Industrial.
Right? More
Yeah, liquidity. We're doing it for options. We're doing it because it is a bit of a marketing thing. Google don't need people to buy the stock, but if this 120, whatever it is now divided by 20, whatever it is, you know, options market will be a lot more liquid for them, so that'll have more buy-in and stuff. So yeah, in the short, I don't really care about the price in the short run, but yeah, it'd be great if Google could crash. But for Google to crash, I think the full market would have to go, personally. But you just can't predict that sort of thing. It's impossible.
Yeah.
Just got to be ready, have the cash ready.
Exactly.
That's what I'm doing anyway, ready to go with all my picks.
Okay, let's see. Let's talk about the Mr. Market thing.
Yeah, let's do it.
Okay.
Yeah, I really enjoyed that post you did about Mr. Market.
Yeah.
And yeah, The Intelligent Investor is, you know, probably the most famous value investing book. I personally think the book's a little bit boring. It's a bit of a dry read because it was written in the 1940s.
Yeah.
And it's really difficult to read. Even the audiobook's quite hard. But if you're going to take anything from that book, there's 3 chapters which are absolutely awesome. The Mr. Market one is probably the best.
Yeah. Have you got it up on your screen? Or?
Yeah, I've got your post up on my screen, and
yeah, we can talk about those 3 points as well.
Yeah, so the point of Mr. Market is every single day when the stock market opens, you are able to buy and sell anything, really. So essentially, the thought is, so every single day, Mr. Market comes to your door, knocks on the door, you open the door, say hello to Mr. Market. Mr. Market says, do you want to buy or sell the market today? And the premise is you have a choice whether to go ahead and buy, go ahead and sell, or do nothing. And every single day, Mr. Market's going to come back and ask you the same question, same, 3 questions. What are you going to do today? And once you understand that and get on top of it, it's a really, really powerful thought process.
Yeah, I agree. And like you don't have to swing. Like you can just wait for the right price. And yeah. And also with Mr. Market, don't let it instruct you. I mean, Mr. Market's there to serve you, not instruct you. So
yeah, don't feel obliged if you see, influencers, YouTubers, whoever, saying, "Oh, this is the best hot stock. Let's go ahead and buy it." You're in full control. You're in full control of, your money, and don't let other people influence you. Don't let the market influence your decisions.
Yeah,
you rule the market. So when I say I want to buy Google at $2,000 per share, for example, I'm not buying until it hits that. And that's how I control Mr. Market. And it's very, very powerful when you understand that.
That's true. That's true. I agree. And one day it will hit like 2,000 because things move in cycles. Like things are in favor and out of favor, and you want to buy when they're out of favor because that's when the money is made. So don't let Mr. Market tell you what to do. Like you're in control.
Yeah, when the market sentiment, swings out of the company's favor, that is the best time. Like at the minute with Facebook, I can't quite believe how it's really surprising just how low my opinion anyway, the valuation of Facebook, it's crazy. But Facebook's one of those stocks where it gets bad news and it just absolutely plummets. So, which is just good for for value investors of all kinds when you can invest in a high quality business. Yeah, you can't predict what the price will do, but you're just gonna wait. If Adobe never gets to that price, I'm not going to buy the stock. It's as simple as that. And that's the thing. I will just have to find a different stock to look at.
Exactly.
But valuations revert to the mean in the long run. Adobe can't be a 40, 50 PE forever. It just doesn't work.
Yeah, that's true. Like, at some point, it will come down to that buy price. We don't know when. Might be tomorrow, might be next month, might be next year, could be 5 years' time. Who knows?
Exactly. And that's the important thing. You control when you buy. So, yeah, that's the part of Mr. Market I like the best. You control when you buy. You don't let him decide.
Exactly. And don't have FOMO. Don't FOMO into the stock, even though you like it a lot. Just stay calm, be patient.
Oh, we've got a question.
Yeah.
I recently bought Facebook. Do you think Snapchat and TikTok are taking market share? Well, it's an interesting one. So at the minute, Facebook has got 3 billion users across its 3 main platforms. So Facebook, Instagram, and WhatsApp. So you're talking about how much of the world population? Is that maybe a third? Less, maybe more than a third, less than a third. But anyway, we've got a lot of people. Let's just say that. TikTok, they're both inevitably going to try and take market share. But I think people use these apps in tandem. I know Snapchat is more of a younger audience, people below 30, and they do have something quite good there. But Facebook, we don't know TikTok's financials, but Snapchat, I don't know if they're just becoming free cash flow positive, but their business model has been loss making for a long time, whereas Facebook became profitable after about 6 years or something like that, which is quite remarkable. So yeah, how big of a fish is Snapchat compared to Facebook? I don't think Facebook really care about Snapchat anymore. If I wanted to buy them at one point, and I think it would have been a good move. We could buy them today. I think if Snapchat collapsed enough, so that's a lie. Facebook will never be able to acquire anyone again because of the antitrust. From the naughty step. So even though they could, they won't. But TikTok's interesting because no one knows the financials behind TikTok because it's Chinese owned. ByteDance, I think it's the highest valued private company in the world. So I don't know if they're ever going to IPO. You'd assume they would, but yeah, I'd have to see some numbers. But yeah, TikTok. Zuckerberg clearly thinks TikTok's a threat because of Reels. Instagram Reels are the number one push thing. If you go and have a look on Instagram, I don't really browse that much, but if you do go on it, all you see is Reels. But basically,
I thought I was the same. I thought I was the only one. I'm scrolling and I see Reels like everywhere.
And you see Reels of things you don't follow as well. So you're talking about, yeah, you're literally talking about they're trying to show you things a bit like TikTok where it's random. So yeah, whether that's a good thing or a bad thing for the app, who knows? But
do you think they should create a separate app for Instagram? Should create a separate app for Reels?
Maybe, but I think because they've got so many users on Instagram, they wouldn't do it. They're just going with the flow. If you look every 2 or 3 years, it just changes from photo. Then it became more videos and stories. They nabbed stories from Snapchat. It worked. It worked. They just keep bolting things onto it, and it'll just be what it'll be. But yeah, who knows? Who knows? TikTok's clearly a threat, but will it replace it? I don't quite think so. I think people use the apps for different things. TikTok seems to be just pure entertainment, whereas Instagram, a lot of people do it to keep up with the Joneses, and it's like the life. You know what I'm saying? Like on a profile, whereas TikTok, I don't think it's quite like that. TikTok seems to be like the 21st century short form entertainment. I'd argue TikTok's a competitor for YouTube. If people are spending half an hour on TikTok instead of YouTube, that hurts YouTube, doesn't it?
Yeah, that's true.
So it hurts everyone. It hurts Netflix. If you're spending an hour on TikTok on a night and you're not watching Netflix are hurt, aren't they? So it's not just Facebook. You're talking about all sorts of companies. They're all competing for your attention. And I think it's a really important thing to understand. All of these companies, let's say, maybe like 6 o'clock till 10 o'clock, that 4-hour period, they're all competing for your eyeballs, all of them. They all want you to be on your platform looking at adverts. So it's true. It's true. So they're all competitors for your attention. And people forget that. They just think, oh, social media, this is social media, but it's way more than that.
I agree. Okay. The second point, treat stock as a piece of business is. Would you want to go into that one?
Yeah, let's do it. This is probably Mr. Market's a good analogy, but I think this one is probably better because this is when you realize this point, when you realize a stock is a part of the business. It's not just a number flicking on a screen. It changes your mindset completely. So yeah, investors often forget that stocks are a fractional share of a real business. So Wes, if I was going to buy, let's say you owned a car garage, it wouldn't matter if you had 10 shares, 100 million shares, your business is going to be worth, what the present value of the future cash flows are. So people, when investing into the stock market, investing in stocks, forget the wrong idea and start thinking, oh, it's just a number on a screen that goes up and down, up and down. They don't think they're owning a business where when you buy a stock, you own a very small fraction of a business.
Yeah.
And that business has profit, cash flow, debt, assets. And you've got to understand all of that when you're buying the stock. The stock price is totally irrelevant. A good analogy I like to use is Apple. If Apple had one share, it would be $3 trillion for that one share. At the current, I don't know what Apple's market cap is at the minute, but let's say it's 3 trillion. If it's one share of Apple, Apple's stock would cost 3 trillion. Doesn't necessarily mean it's worth 3 trillion, but that's what it is.
Exactly. That's very true. I think it's very hard for some people to get around that mindset that stocks are a part of a business. Like, it's very, because not many people see it that way, do they? Like, they forget about it.
People invest into stocks because it's a cool idea. People look at your Palantirs, your Teladocs, they look at it and say, I'm investing in this, I believe in this company's going to grow. But I was having a discussion with a friend, and just because the company grows doesn't mean the stock price will. If the stock price is horrifically overvalued and the company grows 50% a year, that would be incredible if they could grow the revenue 50% a year. But if they make loads of losses, it doesn't matter, does it?
Yeah.
So people get the wrong idea. People invest with the heart. They're like, oh, this is such a cool idea. It's going to change the world. Wrong way to look about it.
So when you look at companies, do you care if they're cool or that you just want cash flow?
Well, I mean, it helps if it's cool, but nah, I don't really care if it's cool. I invest in tobacco companies, oil companies. The coolest company I want to invest in is probably Ferrari. Yeah, that's cool, but I'm not investing in it because it's cool. I'm investing because it's got a good brand and it produces a lot of profit and cash flow.
Yeah, exactly.
So yeah, profit and cash flow is number one. What's the balance sheet like? How much debt? And the valuation. They're the main things I look at when I'm looking at a business. But yeah, coolness doesn't come onto my checklist.
Yeah.
Is it cool? Yeah, go on then, all of it. Cool to me is profit and cash flow.
Yeah, exactly. Especially if they make a lot of it.
Exactly. Adobe is a very cool stock to me.
Okay, the third one is margin of safety. I like that one.
Margin of safety is a good one, yeah.
Yeah. So, do you want to go into that one? Margin of safety.
Yeah, so the concept of margin of safety was, came up in Benjamin Graham and David Dodd's book, Security Analysis. So basically the predecessor to The Intelligent Investor. Another quite dry and boring book, but it's a book I need to force myself to read because as a true value investor, you've got to do it. But when you've valued for business, you know, you want to buy, you've looked at Apple, you think it's worth 2 trillion, but it's trading for 3 trillion. Right, okay. The point of a margin of safety is, are you what percentage below your valuation are you going to buy? And an appropriate margin of safety can be different for different types of companies. If you've got a very risky company, maybe, which you're not sure about, you want a higher margin of safety than you would for an Apple or a Google. And if you value a business at 2 trillion, but you can buy it for 1.5 trillion, that's quite an ample margin of safety.
Yeah, and a margin of safety allows you to make errors in the way you value the company. So the bigger the margin of safety, the more room for error. And with those errors, like you probably won't notice it, like kind of thing, because you're investing with something that's there to protect you.
Yeah, 100%.
Yeah, and the less you buy the stock, the more upside potential you have. So before you click buy, you must invest with a margin of safety. That's the most important thing in investing, because we don't know the future. Like, if we did, then that would be great, but we don't. So the way we do that is by having a margin of safety to account for changes in the business. Like, the business might stop performing well. There might be more competition within the industry that affects its margins and the way it makes money. Or it might be allows the CEO coming in and like changing the business for worse. So having a margin of safety account for all those things. But the people, I don't think I've heard anyone mention margin of safety apart from value investors. Like, do you?
No, but margin of safety is a value investing concept, really. Yeah, I mean, your margin of safety can be baked into your return rate. So I'd say for you, 15% returns. I'd say you've got a definite margin of safety baked in there. And some companies I own, I'm looking for a 10% return. My margin of safety is anything if the stock is currently way below what I think it's valued at. It's very rare we'll buy a stock for exactly what I think it's worth. There's only a few situations where I think the company is such of a high quality that, let's say, Google, for example. But then again, is that the right approach? Because should you be sticking to your same margin of safety for all companies? There's no right or wrong answer to that, is there?
Yeah, that's true actually. But also when you're valuing the company and you're putting your margin of safety, make sure you're basing your assumptions on conservative estimate, not something very unreasonable that's literally it will take a home run. Just be conservative. So let's say if a company is growing 20% a year, you might assume 15% and 10% going forward, that kind of thing. So you always be conservative with your estimate and always have an amplified margin of safety. Those are the rules you must follow, and you'll probably do well investing.
100%. When I value a stock, I never put growth rates higher than what they've done. That's something I personally do, because if you're predicting growth higher than what the company has proven it can do, you're playing a very risky game, in my opinion. And you're setting yourself up to fail. It's pretty brutal. It's brutal. Like, but it's just what it is. That the market doesn't care. If you do your valuation and you're over the top of it, the market does not care. You'll get burnt.
I agree. And also, like, say a company is growing at 40-50% a year, like, you're not going to put that because that's not going to be a forever thing. Like
No.
the growth will slow down, so you want to be conservative with that as well.
Yeah, like Facebook's revenues growth has been 30-40%, hasn't it? And which is obviously unbelievable, but we'd be fools to think that's going to continue for the next decade. It's not going to happen.
Yeah, that's true. I think when I did my Facebook one, I just put I think it's 11% and then 9. So
yeah, I did 10%. I got a very nice valuation as well. So yeah, Smith and Wesson's one. Smith and Wesson's an interesting one. I put 0% revenue growth, 0%, and it still shows undervalued. So
no, that's crazy. Those are rare ones as well, isn't it? You put all these bare cases and it's still undervalued.
Smith and Wesson is my proper deep value pick.
Is it?
Yeah, I'd say my portfolio, that is, yeah.
What companies do you own in your portfolio? Like?
Good question.
I'll say mine as well. If I could remember.
Do you want to go through yours? I'm just trying to get mine up.
Yeah.
I know it's bad that I don't know them all off by heart, but...
Okay, so what do you find yours? So what I own Alibaba, Facebook, Tencent, Academy Sports and Outdoors, Intel, Sprouts Farmers Market, Asbury Automobile Group, Marine Max, Corsair, and ASOS. ASOS is my smallest position.
You own ASOS? Oh, wow, okay. That's interesting.
It's like a 1% thing.
Very interesting. You are a pure value investor, you are, yeah. There's no growth names, there's no Tesla, no Teladoc.
Lewis, can we see your portfolio anywhere?
Yeah, Lifted Teacher. If you head over to my YouTube channel, I post like a stock portfolio update every month. You can go to my website as well. I just put it on there. You can see it all. I'm quite transparent with it all. Yeah. So yeah, just have a look, either of them, and you'll find it. So yeah, in terms of what I'm in the stock side, I've got Berkshire Hathaway, which is I've owned that for quite a while. That's about 5% of my portfolio. British American Tobacco, Rio Tinto, the British part of my portfolio. I've got Meta, so Facebook, Lockheed Martin, Walgreens, Intel, Equinor, Activision Blizzard, and Alibaba. Oh, and Smith and Wesson now as well.
That's a solid portfolio, actually.
So I've still got a few more names to get in there, but yeah, at the right price.
How many holdings have you got?
Oh, I think I've got about 10. I want another 12, 30. I've got a few more to go. Yeah, I've probably got another half to go for my watch list. Yeah, I've got a bit of cash to go when, if things come at a fair price. But yeah, I'd love to buy some of these stocks at lower prices as well, because I'm happy about the companies I own. I like the balance sheets, the profits. Yeah, makes you feel comfortable when all of these companies they all make really good profits. We've got solid balance sheets, and buying at a fair price, it'll be good.
And you're also improving your margin of safety with your current stocks if they go down. So that's a good thing as well.
100%, yeah. What do you think? How do you think the markets will start tomorrow? Putin accepted East Ukrainian areas as independent countries. Russian stocks are melting down like the butter. Well, I don't know what you think, Wes, but who knows? Even if Russia invades, we do not know what happens to the market. We just don't know. It's as simple as that. You've just got to be prepared and have you've done your analysis. You've worked out what companies you want to buy, whether it's 1, 2, 5, 10, 20 companies you want to buy at whatever price. You just need to be ready for when it does. It's as simple as that. Who knows if the market will go down if Putin invades? But yeah, we just don't know, do we?
Yeah, and you got to be psychologically prepared as well. Like, don't get scared that stocks are not going to go to zero. That the index fund's not going to go to zero. Just stay calm. Just wait for an alert to go off your favorite stock on sale, and just buy stocks on the cheap. Don't buy them because it's like 10% down on that day. Buy them because you valued them on a conservative basis, and they're actually below the intrinsic value.
I couldn't put it any better, mate. Simple as that.
Yeah.
Simple as that. Even a stock goes down 10%. Oh, we're buying a dip today. Doesn't buy it. I hate that phrase, buy the dip.
I hate that.
Oh.
I hate that. It annoys me because
it's so annoying.
When the market's down like 2%, right? Everyone's saying they're buying dip, right? But I have nothing to buy because my stocks aren't really that volatile. So I like to buy when it's a huge drop from what I bought it at. So if I bought a stock at 45 and it drops to 40, like there's not much, room to average down. It's not gonna. It takes a while for the thing to go down. Yeah. So if I bought it at 45, I want it to go to like 30 or something, and that's a good thing for me because it brings the average down way more.
Yeah, 100%.
There's no point in buying on 2% dips. It's just waste of capital, really.
Yeah, no, I'd agree, 100%. Yeah.
Like my Intel, right? I actually bought it around 55, I think.
All right, okay.
Yeah, and it's at 45 now. That's the kind of drop I want to bring my average way down. Yes, exactly. Set my alarm at price.
Yeah, Yahoo Finance is a good app for that. Yeah, I've got my watch list set up on Yahoo Finance. It's a shame they don't have alerts for British stocks, but I just type in what my target price is, and it'll just send me a notification when it gets there. It's what happened with. Yeah, so that's what I do.
I'm thinking of getting in PayPal.
Oh, really? Do you like it?
Yeah, I like it, but it's not something we're gonna put like huge allocation for. Maybe 10% max, really.
Yeah.
Nothing like higher than that, but I want it to fall more though. So below maybe $90.
Yeah,
just to get that margin of safety, more room for error. But it's an interesting company. What they use to calculate stock prices is their website. No, we have our own discounted cash flow models we use to calculate stocks.
There's also Everything Money's website as well that you can use their like stock analyzer tool, and it does a pretty good job on the face of it. Yeah, it does a fair job, to be fair.
Yeah, I use it as well.
I use that as a different. So I've got my spreadsheet, but I use it as a different method because I think it's always good to like if you post something about stock, I find it interesting. I'm like, okay, what does Wes value it at? Just as a quite an interesting thing. But Everything Money's absolutely solid. So yeah, that's a decent place to start.
Yeah. But yeah, don't with the market tomorrow, don't think too much about it. Like whatever happens, really. It's out of our control.
Who knows? We might be able to buy Gazprom at a PE of 1, or some Russian mining stocks, really low valuations. But who knows? There's a company called Yandex, which is like the Russian Google. Might be an interesting one to look at.
Type in the chat. There we go. So, would you say, do you think people should tamper with their portfolio because of this Ukraine thing? Like some people are saying, I got to get some more value stocks to break the volatility, or got to get some REITs or whatever. Like, or should you just like just relax, like just buy cheap? Because I see a lot of people like panicking and not sure what strategy to implement with their portfolio during this matter.
Yeah, I can only really see what I do. I try and buy good quality companies at a fair price. I don't care what's happening. I see stuff like this Ukraine stuff as an opportunity. In terms of if the market falls or certain stocks fall, I just see it as an opportunity to buy at a fair price. I don't change my strategy. There's going to be a war, let's buy Lockheed Martin. I don't think like that.
You should only buy Lockheed if it's actually a good deal, not because there's a war or whatever.
Yeah, like I want to buy more Lockheed, but I want it to get below $330. I'm just going to wait. It's simple as that. There's a few other defence companies which are looking half decent, but Lockheed's my favourite out of all of them. So, but
I like Lockheed's actually good. I have it on my watch list.
Do you like Huntington Ingalls?
Yeah, and Huntington's pretty good. I like as well.
I do like that, but I don't know if I want to own loads of defence companies in my portfolio. But then again, if it's a good quality business, I don't necessarily care too much.
Yeah.
I just don't want to own like 50 stocks. That's my issue. That's why I'm quite not picky, but I want to own like 25 stocks and that's it. So I've got like quite a brutal cut-off process.
I started investing last year and got sucked into the growth stocks, and now I'm down $4,000.
Oof, poor man.
I want to learn how to do it properly. Maybe cut some losses and invest in index fund. I think that's probably. I mean. So what growth stocks was you invested in? OB? And it's good that you learn a lesson as well. Like it's always good to learn.
Palantir.
Palantir. Either Neo, maybe.
Teledoc.
I know Neo was like literally everyone's favorite. Pretty much all of them.
Well, take the experience of losing $4,000 and just treat it as a very expensive training course. Get yourself send me a DM if you want. I'll send you some links to some resources, and if you want to learn about value investing or and stuff, just everything money, learn to invest, Sven Carlin, get reading some books, be it Rich Dad Poor Dad, Little Book of Common Sense Investing. Just get educated. Oh, fantastic book.
You own 50 stocks. Yeah, that's gonna be.
That's hard work, is that?
Yeah. For me, like, if I was in your position, right, I'd probably treat it as an important learning lesson, as you were saying, Lewis, and just look for a process, whether that's go full on index fund, maybe I want to try again, but properly, and go like the value investing route. It's up to you, really. Like, but if I am going into a new process, I wouldn't want to keep any of those stocks, really.
Yeah, get yourself educated. That's the most important thing. There's been a lot of people in the past 2 years that have gotten into investing, be it crypto, the stock market. A lot of people have got really interested in it, and a lot of people have got sucked in. and just saying, oh, everything goes up. But the sad reality is that doesn't happen. And you've got to have some sort of process behind you, whether it is monthly, you just put it into an index fund. There's all sorts of different ways you can do that. It can be done automatically by transfer each month. It sets it up automatically. If that's the best way for you and you don't want to look at individual stocks, go for it. I can't knock you for that.
Simple, isn't it?
Simple. If that's something you want to do, if you want to push the boat out and aim for some higher returns, then learn about value investing, learn about individual stocks. Yeah, that's the way. That's the way I see it.
Yeah, you got crypto too. Yeah. Well, you've only been investing for a year, right, Obi?
Yeah, I have to make a move soon, mate.
Yeah. Okay.
Got any more questions?
Yeah. If you got any May, yeah, Obi, if you got any questions, like shoot either me or Louis a DM, like we answer it. So yeah, hope it all works out in the end though for you.
Yeah, I'll send you some books if you want on Amazon. Yeah, get yourself educated. That's the main thing. Even if you're not interested in individual stocks, learn about index funds, just learn about the benefits of compounding. Yeah, you got to start somewhere. But yeah, use audiobooks, use YouTube, use podcasts, and just absorb as much as you can because it takes time. You don't get it overnight.
Exactly. Should we call it, Lewis?
Yeah, let's call it. Yeah, it's been another good chat.
What today, actually? No worries, man.
No worries, nice one.
All right then. Yeah, thanks for watching, everyone, and we'll be back again next week. Hopefully, we're on my setup. I'm not in my room, but thanks for watching, everyone. And
yeah, thanks for watching, everyone. It's been good. See you later.
See ya.